Welcome to the Chapter 6 videos. We've broken the Chapter 6 videos down into 3 separate videos. And the first video is to explain a little bit about Chapter 6 and some of the issues we have, and then at least one of the assumptions we make. Chapter 6 is on inventory costing. And if you see on the screen here, we've got a typical situation for a company. They have 3 different levels of inventory. Now these inventory, the December 1st beginning inventory, the December 6th purchase, and the December 8th purchase are all the exact same inventory. You can't tell the difference, whatever they are, chairs let's say. You can't tell the difference between the beginning inventory chair and the December 6th chair. But as you can see, we've paid a different price. Paid $22 for the beginning inventory, $23 for the December 6th, and $24 for the December 8th inventory. And again, all the units are exactly the same. You can't tell the difference. Okay, on December 10th, we went to sell 70 units, or we did sell 70 units. So we put 70 units into the truck and delivered them to our customer. Well, for accounting purposes, we have to decide what is the cost of goods sold. What is the cost of those 70 units or 70 chairs that we sold? Well, you have to decide which 70 chairs did we sell. Did we sell some from the beginning inventory, from the first purchase there, or from the December 8th purchase? We don't know. Remember, all the chairs look identical, so we truly don't know which ones we sold. So you see the problem here. We've got to come up with the cost of goods sold, but we don't know which 70 chairs we sold. So we have to make some assumptions. And the generally accepted accounting principles allow us to make really one of 3 assumptions. There's a 4th one here that I will address briefly. But basically one of 3 assumptions here. And these assumptions are used to determine our cost of goods sold, and then at the end of the accounting period to determine our ending inventory. Of course, cost of goods sold is for the income statement. Ending inventory is an asset for the balance sheet. The first assumption we could make is FIFO, or first in, first out. And just like the name implies, that assumes that the first units we had in are the first ones we sell. Or we could use LIFO, and LIFO assumes that the last ones in are the first ones out, so that the last units we got in are the first ones we sold. And then the third assumption we can make is weighted average, and Clay, my mouse keeps disappearing there. I think that's an adjustment we can make maybe. But weighted average is where we just take an average of everything. That's all right. If you have to come in, don't worry about it. We'll live with it here. We'll get the mouse back on the next video. So let's do an example, and let's go back to that example we just had on the previous slide there. And you see again we've got 60 units that cost us $22. We've got 40 units that cost us $23, and 50 units that cost us $24. Then on December 10th, we sold 70 units, and we have to decide again which 70 units we sold. Well, in this particular slide presentation, we're going to assume FIFO, first in, first out. We're going to assume that the first units in are the first ones sold. So, under that assumption, which 70 units of inventory do we assume we sold? Well, wouldn't we assume that we sold 60 of those that cost us $22, and that makes up 60 of the 70 we sold? And then we dipped into the next layer of inventory and assumed that we sold 10 of those that cost us $23. And so you can see how I did this on the next slide here. I have a separate column for cost of goods sold, and so as I calculate the units I sell, I put in here the 60 that cost us $22 and the 10 that cost us 23. Okay? All right, next thing that happened is that we made a couple more purchases. I'm sorry, we didn't make a couple more purchases. What I'm doing here is I'm updating my inventory. I'm updating my inventory. Every time you make a sale, like we did over here in the cost of goods sold column, you want to redraw your inventory. And so that's what we've done. And always have your inventory listed earliest to latest. So we don't show the December 1st inventory anymore. We start with December 6th. Why aren't we showing the December 1st inventory anymore? Well, because we assume we sold it, right? We sold all 60 of those units. The December 6th inventory, we're only showing 30 of the units because we assume we sold 10 of them. So we've only got 30 left. Well, and we haven't sold any of the December 8th units. We still have all 50 of them. So we're showing 30 units that cost us 23 and 50 units that cost us 24. Well, let's see if we make another sale. Well, we make another purchase first. On December 17th, we purchased 20 that cost us 25. Then on December 28th, we made a sale of 90 units. All right, put me on pause and go ahead and do like we did earlier with the sale on December 10th. Go out to the cost of goods sold column and write out which units you assume we sold under FIFO. Which 90 units did we sell? All right, let's see if you got that correct here. So what I've done is I've gone to the earliest batch first. Assume I sold all 30 of those that cost 23, so I've got them in the cost of goods sold column. Then I went to the next batch and assume I sold all 50 that cost 24, so I've got that in the cost of goods sold column. So that's a total of 80, isn't it? That's a total of 80 there. I sold a total of 90, so I had to dip into the $25 batch to the tune of 10 units. And so you can see I moved to the right there. And so here you can see our layers of units that we assume we sold. What do we still have left? Well, we sold all but 10 of those that cost us $25, so our ending inventory is going to be valued at the 10 at $25 or $250. And our cost of goods sold, and of course the ending inventory will go on the balance sheet as a current asset. Cost of goods sold is just the sum of all these figures over here in the cost of goods sold column, 1320 plus 230 plus 690 plus 1200 plus 250, giving us a total cost of goods sold of 3,690. So that 3,690 will be an expense called cost of goods sold, and that will go on the income statement. So that concludes this video on FIFO. The next video is going to be working the same example, but under LIFO.